I'm Shintaro Yamaguchi, an international tax partner with PwC Tax Japan, where I lead the inbound and U.S. outbound tax practices. Today, I'm delighted to have with me Doug McHoney, PwC's global leader, International Tax Services. Doug has his own podcast, the Cross-Border Tax Talks, where he's hosted over 100 episodes addressing the latest trends on international taxation, together with PwC's experts from around the world. Doug, thanks for joining us.
Thanks for having me. It's my pleasure.
Today is the first session of a four-part series where I'd like to discuss Pillar 2, the newly introduced global corporate minimum tax, which has been largely driven by the OECD. The OECD has developed detailed guidance, and in essence, the Pillar 2 requires large multinationals to pay a minimum of 15% tax in countries in which they conduct business. Over 130 countries have ratified Pillar 2 in principle. And Japan is one of the first countries to implement draft legislation as they have as part of their FY23 tax reform. That said, Pillar 2 represents a significant overhaul of the international tax system. And so understandably, countries are at different stages of the implementation process. As we go into 2024, the go-live date for Pillar 2, where do you see Pillar 2 going, Doug?
Well, first of all, Shin, you're absolutely right. We've never really seen anything like this in our careers, really in the history of global corporate international taxation, really.
That's right.
Common global tax base where implementing jurisdictions can allocate the taxes that are due for these top-up taxes across the implementing jurisdictions. Now, what I think is very interesting is that the rules were, you could even say, cleverly designed to encourage countries, once one country implements the rules, for other countries to then also implement the rules. And what I mean by that is that when there's the income inclusion rule and the undertax payment rule, which is effectively the mechanism by which the top-up taxes are collected. And if one jurisdiction and only one jurisdiction, let's say Japan would be the only jurisdiction to implement Pillar 2, then theoretically Japan could collect the top-up tax for every multinational around the globe. And so the rules are designed to encourage other jurisdictions also to implement these rules such that the top-up tax can then be spread across all of the implementing jurisdictions. Now, you had mentioned that there's over 130 countries that have signed on to Pillar 2, and the United States was obviously one of those. Now, unfortunately, I think many of the jurisdictions that signed on to that initial agreement with the OECD will not be implementing the Pillar 2 legislation.
Due to their own political situation, et cetera.
Exactly. In the U.S., we now have divided government, as you well know. The Biden administration, while the Democrats controlled, were unable to get the changes through to be able to make the U.S. regime compliant with Pillar 2. And so right now, the U.S. does not have a Pillar 2 compliant regime. And given the split government, the likelihood of them actually implementing the rules is remote, if not zero.
But what does that mean for U.S. multinationals?
So for U.S. multinationals, even though a parent company, an ultimate parent company, has not implemented the rules, to the extent that they operate in a jurisdiction that has implemented the rules, as the ultimate parent entity, which is a defined term in the Pillar 2 guidance, they are going to be required to comply. So U.S. multinationals, really any multinational that has greater than 750 million euro top line revenue that operates in any jurisdiction where Pillar 2 is implemented needs to pay attention to this, because ultimately they're going to have to provide for financial statement purposes and ultimately file the tax compliance forms for Pillar 2.
That's a great point, because there was a lot of discussion last summer, if I recall, as to whether the U.S. would pass Pillar 2 compliant legislation. Now, as you pointed out, they ultimately were not able to pass it, but ultimately the impact on U.S. multinationals, and as well as the Pillar 2 system as a whole, because it's interconnected, is somewhat, perhaps not limited, but life will go on. And as you point out, Pillar 2, the Pillar 2 process will continue forward.
Yeah, and there's a number of complex questions with respect to how does the U.S., particularly our GILTI regime, for example, and the regime that applies for our CFCs, how does that interact with Pillar 2? How are those taxes allocated? And I think that's just one of many of the significant complexities that we see with Pillar 2, and how does it interact with existing tax systems? How do the covered taxes work? And a number of challenges. The other one I think that's important to note, Shin, is that we're talking about a tax base that is based on financial statement income using the accounting system of the ultimate parent entity.
Right, which is entirely new system.
Which is an entirely new system,
Yes.
and something that as tax professionals, I know we've had to spend a lot more time thinking about accounting principles and understanding. And so
Indeed.
it's a major challenge for any multinational to really to create these opening balance sheets, if you will, for Pillar 2 to ultimately be able to do the calculations.
Yeah, let me take this opportunity to switch gears for a second. We've been talking about tax policy and how governments have been approaching this. So talk a little bit about how multinational corporations are addressing this. Now, as I mentioned, the Japanese government is one of the front runners, and so Japanese companies have begun the process of gathering information necessary to perform calculations, assessing any potential exposure. But this is an issue that I suppose all multinationals are grappling with today.
Absolutely. The biggest challenge that we're seeing for multinationals that are addressing Pillar 2 is getting the data and really the operational readiness to be able to tackle this challenge of this entirely new system. And what we've learned at PwC and what we're seeing as we've talked to our clients is that it really takes a broad range of stakeholders to address this. Historically, international tax calculations like this would be done by international tax professionals like you and me.
Calculate the taxable income.
Yeah.
Maybe some interjurisdictional complexities, et cetera.
And what we've learned is, well, we need systems people to be able to understand and get the data out of the systems. We need not just tax accounting people, but often accounting people to understand how some of the transition rules and how to set up some of those opening balance sheets that may apply. And it's really a multi-group, multi-stakeholder process, getting that group together to be able to be ready such that when those rules come online, and particularly January 1st, 2024 for that income inclusion rule, and potentially even some of the undertax profit rules, depending on how jurisdictions choose to implement those, it is a massive undertaking for either large or smaller companies. Of course, you have to meet the 750 million euro threshold. But it's not too early to stop.
And how are tax departments approaching this, given that this is a relatively heavy lift with all the data gathering involved?
I think that, like at PwC, we have really tried to get the stakeholders involved immediately. We've spent a lot of time thinking about what data is required, specifically the data input catalog, and then really trying to map how do we get the data out of the various ERP, consolidation systems, provision systems, tax compliance systems into the form that we need to do the calculations. And it's really critical for companies to start now, even though they may have until January 1st, 2024 before that first provision, and then ultimately additional time before the first compliance is due.
Now, this is very much an learning process, which requires a lot of interactive discussion, as you pointed out, between advisors, clients, within the various departments as well. So it seems like everybody's got to go all in for this.
Yeah, and there's a lot of time and budget and resources from a technology perspective. Presumably advisors will be involved to be able to get ready for this. And it's something that none of us have done anything similar to this in the past. So it's important that many tax departments are already spread very thin, and having this layered on top is just another challenge that we're seeing across the globe.
Doug, thanks very much. I mean, there's so much to discuss, but I think we're just beginning to get this discussion going, and I look forward to continuing this discussion with you. Again, thanks for joining us, Doug.
Thanks for having me.